Hello and welcome to the ETF show, taped right here at the New York Stock Exchange. I'm your host, Kristen Myers, ETF Editor-in-Chief of Asset TV. Thanks so much for tuning in today. Now, today we're going to be discussing active and passive investing strategies. But first, let's take a look at some of these quick stats. Now, according to the S&P, actively managed funds historically underperform indices over time. Now, the S&P has also found that active managers rarely stay at the top. So looking at the top half of best performing funds, they found that starting with more than 1,000 actively managed funds, only 336 remained in the top half after a year. And that number dropped to just 43 after 4 years. So for more, we're joined now by Joseph Nelesen, Head of Specialist Index Investing Strategy for S&P Dow Jones Indices. Joseph, thanks so much for joining us today.
Thank you for having me.
So as I was just mentioning, a lot of those stats. Now, the SPIVA report has been done now for more than 2 decades. And there has been some persistence in that research and in those numbers. So how should investors really interpret the fact that so few active managers manage to stay in the top over time?
You said it very well. It's very difficult to stay there over time, even to do it over the short term. I think that, look, we've documented in many of our SPIVA scorecards, which we started back in 2002 for the US, and we've started to expand into other markets around the world. And now we have, over a dozen SPIVA scorecards covering really every continent except for Antarctica, I like to say. Right? There are active funds everywhere. And the story is similar directionally in that as you get over longer time horizons in almost every category, especially over long time horizons, most managers underperform indices. Now, there are reasons we can talk about, which we read about why this happens, and I think some of it goes back to the difficulty in markets of trading that's happening behind us. Right, it's a challenging game. Fees play a role, but the trends are long-term converging. Short-term, we find some interesting things to write about when it does vary a lot year to year.
Now, you just mentioned, some of those reasons for the underperformance. Is that it? It's market volatility? There's nuance to even some of the category. Are there other, reasons for some of that underperformance, and a reason that a lot of these managers struggle to not just outperform, but outperform over time?
Well, let's be very clear. We live in an age where indexing has obviously grown, right? And as a consequence of that, the number of active mutual funds has declined a bit, right, from where it used to be. There's still many, but what's happened is you've seen this increasing professionalization, right? Those that remain in that game are among the best. And we've never said that there aren't really smart, talented teams running active funds. They face a very challenging proposition, though, right? You can go back to some of the academic papers, William Sharp talking about essentially the distribution of alpha. When you factor fees into the equation, mathematically, less than half of funds can outperform when they have that hurdle to overcome. But it isn't just fees, right? We were faced with that question years ago. Is it just a fee equation here happening? We explored that by doing an institutional version of SPIVA where we take out the impact of fees, and we find that it is still a equation where the majority of funds underperform on a non-fee basis. So you mentioned volatility. Volatility cuts both ways, right? We see volatility spoken about as a good thing for active management. In fact, it can be when you have wider dispersion between stocks and bonds that allow people to generate alpha, but it also creates wider risk, right? You can have severely underperforming securities that unfortunately they may own at the wrong times, and that creates a lot of the challenges that we see.
Is this true, this sort of persistence and this trend that you're seeing? Is that true for all categories? Because we have found that a lot of investors, a lot of active managers do like the active category for some more nuanced sectors. Fixed income, really comes to mind. So is that true for everything?
Over long term, we tend to see it true to the extent that the majority of funds underperform. Now, the degree of that underperformance, and the proportion can vary. Fixed income you brought up is a great example, right? Where in some fixed income categories, the spreads of returns between the best and the worst are narrower. Think about short-term bonds, for instance, where you can have a big shift in rates in a certain part of the year or multiple years, like we had during COVID. And managers can take advantage of that, right? Benchmarks are just tracking what's available. Generally speaking, managers can navigate. And so what we see often in the fixed income categories is those that outperform are doing it with a lot of deviation from the benchmark that applies to their fund, right? Think short-term managers, delving into longer dated when that makes sense.
Right.
What we see a lot is IG funds that are holding a little more, risky credit, high yield than the benchmark would normally say is appropriate. And so they're allowed to do that, but those are some of the ways that we see managers, when they do outperform, taking advantage of the markets around them.
So I want to do a slight pivot now. You did have a report that was, recently released. That's going to be the SPIVA US mid-year
Yes.
for 2025. I want to bring in another stat. So that report found that more than half, specifically 54% of the actively managed large cap US equity funds, underperformed the S&P 500. But they didn't underperform as badly as they had in the past. So what really is the cause behind, if we want to call it a sort of upward momentum?
Let's look at 54% two ways, like two sides of a coin, but it's almost 50%. But you're seeing that underperformance rate that's telling you just more than half of managers through the first 6 months of this year are underperforming the 500, right? These are large cap US managers, so that's the appropriate benchmark for them. What's happening, and what we've seen in years like this, if you think back to 2022, where we had a similar underperformance rate for the full year, that was a year where the market was down. I mean, we're not in a down case this year, but what was interesting was that the largest stocks were leading the way down. Right. This year we had a bit of weakness in the Mag 7, the top 10 or 20 names relative to other years. That tends to favor active managers, and the reason we found is that on average, active U.S. equity managers don't hold the largest stocks at market weight. They are often less, right? It makes sense intuitively. Their clients aren't going to pay for just holding the Mag 7 at a high weight. Maybe they will, but they tend to be looking for opportunities in the mid and smaller end of the range. So when we see this kind of dynamic where when the largest stocks are leading the way down, more managers do well. When the largest stocks are leading the way up, which has been the case for a lot of the last couple of decades, more managers tend to trail, right? Because that's kind of the common characteristic we see. So I think that's what has fed into this dynamic this year. Now, 54% relatively better than the 65% underperformance we saw last year, right? But if you look at that over time, even if that were achieved year after year, you as an investor are still going to face a situation with a slowly diminishing, number of managers who continue to be there at the top of that performance.
Now, also looking at this report, it wasn't just, the large cap U.S. equity funds that sort of underperformed, better than they did last year. There was also improvement elsewhere. Small caps saw their smallest underperformance since the report began. Is there at all a sign? Is this a sign that active managers are just getting better?
It's hard to say if they're getting better in the aggregate, right? The data don't support that, but you pointed out a great statistic, and this is why we love to write the mid-year, because it's kind of a pulse check on where the market and the active community is headed. And they had a great result for the first half of the year, right? It was something like a third, a little less than a third underperforming. Again, when we pull back the layers on something like small cap, you see more managers holding stocks in the mid and large cap of the range, right? The 500 did much better than the small cap 600 for the first half of the year. And so, an astute manager would take advantage of that, maybe move into some of the larger cap stocks that on average did better. And that fueled some of the outperformance. I think what we've found that's interesting is that's a very great statistic over the short term. Over the long term, it does converge toward that 80-90% range.
Right.
And one of our colleagues earlier in the year did a bit of research about this, where he looked at not only small caps, but emerging markets, where you might have more volatility, and there's this notion that an astute manager could take advantage of that. What he found was that in higher volatility or higher dispersion regimes, the underperformance rate on average went up. Right, and so it goes back to that first point around, more opportunity can also equal more risk, and where the funds find themselves tends to be on the risk side over time.
Now, another report that you guys released is going to be the after-tax report, and that was for the full year 2024. That was recently released. So I want to read this quote that you guys actually had said in the report. Now, it said justification for an index strategy can be found in the potential tax implications, and that surpassing broad capitalization weighted indices becomes even more difficult when considering the tax consequences of active trading. So this fund, obviously looking at the funds that performed best after taxes, the active or the index funds. That says it right there. Right. The index clearly performing better. Can you tell us a little bit more about that, what that report found, and what was the performance really after some of those after-tax consequences or implications were considered?
So that quote is a more eloquently worded way of saying, trading is hard, right? Timing is even harder, and taxes are inevitable.
Right.
What I mean by that is, we encountered many investors who look at SPIVA and they're thinking about this from their own investor experience, saying, I see the performance numbers you're showing, I see the return performance you're showing for funds. Why is it that I have a year where I have an active fund that underperformed the market and I'm getting a tax bill from a capital gains distribution? Right. So that's really the investor return, I like to say, what they're actually experiencing. And we wanted to find a way to capture that. So we started about 3 years ago looking at the after-tax performance of all of the active funds in our database, right? Thousands of them. And we do this using a process that the SEC has installed since 2001. I mean, funds are technically required to report after-tax performance. So it's going to be lower, right? If you have cap gains, there's a bill to pay. Your investor experience is a different return than what's stated on the prospectus, perhaps. So when we run these types of numbers in the U.S. equity market, we find that on average, it's about 2% less return for funds across categories. Now, we did the same impairment on the benchmark itself based on distributions, dividends, and it's around 50 bips less annualized, right? So you have this lower performance. What that's translated to in terms, Kristen, is in the US for large cap US equity, over 5 years, ending last year, 80% underperformed on a pre-tax basis. When you factor in taxes, that goes up to 93%. So it can be a significant difference around whether they're just hovering toward that margin of beating the benchmark or not when it comes to taxes.
Now, this is the ETF show, and that report was looking at active mutual funds. So I have to ask, does that, or would that still hold true if this was looking at actively managed ETFs? Because ETFs naturally are going to be more tax efficient than their mutual fund counterparts.
That's right. On the whole, ETFs have a different structure, as you know, right? The creation redemption process can allow transaction and changing in flow without making trades. That's one of the difficulties in mutual funds. In a bad year, for example, is that if everyone's redeeming the fund, the manager has to sell off probably appreciated securities, and whoever's left in there is holding the bill. That's what we've seen. ETFs, that happens less, although there are, on the margins, maybe some different things. We haven't yet published a carve out for the active ETF space yet, though, but maybe we'll be talking next year when we do. I think it's something that's been come up so much, and I think there is a better tax, a more efficient, let's call it, tax structure for ETFs that may help in this after-tax regard. Some of the same competitive dynamics we talked about earlier still apply, but now we're entering an age where the vast growth in the number of active ETFs listed is giving us a robust enough data set that we can actually dive in and roll up our sleeves. So I expect us to come back with a little more work on the active ETF segment and how it compares to indices, both on a pre and after-tax basis.
Based on, not to get ahead of some of the report of the research that you guys have sort of published, but does it at all, or would it, do you think, change the picture that SPIVA has really painted about index sort of outperforming active and passive outperforming active once those active ETFs are considered?
Probably not. I mean, and I say that because in the after-tax SPIVA scorecard, we do a chart in there where we break down the percentage of funds that underperform on a pre-fee, post-fee basis, and post-tax basis, right? And that the taxes and the fees are significant slivers, but they're very small compared to the just gross of fee, everything else excluded performance. And so the challenges faced in active management across asset classes are more inherent to the markets than they are to fees or taxes. Those are kind of the extra levels. But we don't see that it would have a big directional change where the majority would outperform. But again, over the short term, anything can happen. Right.
So for those active fund managers, what are some of the takeaways that some of these reports show so that they could remain in the top half of performance?
It's hard for me to say what
or is it give up and go to passive?
I don't think it's give up. I think what's really been interesting in the evolution of indexing and even passive, I think, is becoming a misnomer for this space, because what's happening with indices is a very active application. more and more active managers that I've encountered over the last decade are using index-based tools, whether they're building model portfolios, whether they're using them in a multi-asset context instead of stocks. We see this around the world. So they're using these instruments. That's why we see trading between $200 and $300 trillion on S&P 500 linked instruments around the world. And the short-term trading is happening a lot more. Active managers are using indices as their tools, and I think that's providing an extra layer of diversification that's helping some of them manage around this and maybe going kind of cap weighted some area and targeted in another. And that seems to be the new evolution.
Is there anything that can be used to sort of change, to break this cycle at all, for anyone that wants to use some of those active strategies? You
mean from a fund investor perspective? I think it's probably best, based on some other work we're doing around these models, right? That we have active and passive models we see in the marketplace. The data suggests that it's best to place your effort in the areas where you can have the most impact in the portfolio if you're trying to find a good manager, right? They're out there. There are managers who do it. We've seen they're statistically rare, but it's hard to find one across every slice of the portfolio, right? And so that's why we see this blending of active and passive, and maybe putting that diligence effort into a place where there's perhaps a manager doing something that's less index-like or isn't really available in that format, and then surrounding that with a well thought out allocation.
All right, Joseph Nelesen, Head of Specialist Index Investing Strategy for S&P Dow Jones Indices. Thank you so much for joining us today. And thank you so much for tuning in to the ETF show at Asset TV.